The share price of the company I'm looking at today is 57% below its high in 2021, but it's profitable, valued below its net assets, and pays a 4% dividend plus. It's also in a sector that has been hit massively by negative sentiment, house building, and many see more troubles to come. But is maximum fear an opportunity here if you're looking longer term? Let's have a look. That company is MJ Gleeson. GLE is ticker. What do? There's two parts of the business. They build homes, affordable housing. A big part of the market is first-time buyers, and that's mainly sort of north of England, and also Gleeson Land, which is mainly the south. Now, what they help do is sell on behalf of landowners. So what they do is get planning development on the land, then they market it and get the best price, and they have an option on that land, and they don't actually buy the land themselves, so it's not as capital intensive as it sounds. So let's look at their homes, for example. Northeast, Northwest, Yorkshire, the Humber, East Midlands. So you can see in the green there, that's their price, and the grey is the price of other house builders. So they're a lot cheaper, okay? They specialise in, let's say, homes for first-time buyers, and 2/3 of their market are key workers. They're looking to expand this proposition. So they did release a trading update recently, and this is for the year ended the 30th of June, because their full year is up to that date. So they did a trading update, and this is what they said. Gleeson Homes completed the sale of 1,723 homes during the full year. That's down 13.85% on 2,000 homes sold last year. Now, it's worth looking at the breakdown in the 6 months, because during the second half of the year, they did 829 homes, right? And that's down from H2 22, which is 1,068, so it's 22.37%. So the drop is accelerating a bit. If we break this down, and they do say this is reflecting the downturn in the wider economy and the immediate impact on buyer confidence as a result of higher interest rates. So 894 homes were sold in H1, 829 sold in H2, so 65 fewer were sold in H2 and H1. So you see, it is slowing down a bit. And they also said there's a significant shift in buyer demographics in the second half, with first-time buyers accounting for 50% of open market reservations. That's down from 71%. So you may say, what's a bit of an issue here? Because if they're pitching to first-time buyers and that demographic is not affording it, or taking less the percentage of their sales, then maybe there's a problem. But this is compensated for over 20% of sales were purchased to over 55-year-olds, which has gone up from 10% to 20%. So that's double there. The group ended the year with cash balances of 5.2 million, no debt, because it's funny, the house builders going back, it's not funny, but going back in the great financial crash, they had a bit of debt, but they sort of learned from that lesson. And many of the house builders now carry very little debt or no debt whatsoever. But what's a little bit concerning here is that cash level has gone down from 33.8 million and no debt. Now, how is that if they're not loss making? So they said this was a pleasing outcome given the significant investment during the period in bringing forward a higher proportion of new home starts. Okay, so they've invested in more and building more there. And by the way, this is quite encouraging, and this will largely reflect going forward. But they sold a portfolio of homes to Carlisle. Now, Carlisle is sort of a global investment firm. It's listed on NASDAQ, and the sale of 228 homes across multiple developments, of which 66 homes are expected to be completed in the financial year this year, with a balance in 2024. So there's a nice chunk of balance into that year. The consideration for the sale totals 50.4 million payable in cash upon completion of each home, save for a small retention. And they did say the board expects the results for the full year to be in line with market expectations. All right. By the way, they also say in the Capital Markets Day, there's a medium-term opportunity, strong growth potential in both businesses. Gleeson Land well placed to expand its regional presence and rate of acquisitions. They're going to accelerate that there. And they say Gleeson Homes has a visible route to 3,000 units in medium term, implying double-digit percentage growth. So that normally the units on their land is a lot smaller than that. So they're upping the size of their sites, basically. And opportunities to improve both margin and returns, a stable environment would be significantly accretive. And also, they say, by the way, it's much bigger, longer term, the upside. So broadening our proven model, refreshed our product to broaden appeal to attract the squeezed middle. So not just first-time buyers now, they're widening the market to older and second-time buyers, increasing the product range to improve flexibility, expanding our geography to capture more of our core target market, and exploring opportunities in partnerships. Gleeson Land, expanding the footprint, do more where we are already, but geographic expansion into areas sharing same market dynamics. They're going to further afield, but also do more in within. And they say here, opportunity to be a 10,000 unit house builder with materially scaled land promotion business. So that's a huge, uplift in where they are now. But let's have a look at the spreadsheet here. Let's go two here, but let's go back to the fundamentals here. So this is last year's results, and this is most recent 6 months. This is 12 months, okay? So share price 383, market cap 223 million, enterprise value 189. That's because they've got more cash than debt. Net asset value 272. So you can see that's way above 223 there, which is a good sound. Decent liquidity here. Revenue of 373 million, operating profit of 43 last year, cash of 33, debt, we know that's gone down at a 5.2. Obviously, the assets have already gone up. Operating cash flow 11, free cash flow 9.7, dividend yield 4.7%, and they got cover of that 3.34 times. But let's look at this, how it's changed here. So we can see operating cash flow has gone down because they're building more, and free cash flow has gone down as well because they're investing more. But nevertheless, still below net assets, and operating profit here of 16 million. And dividends still there. So you can see the change here in colours. Look, the growth has gone down here in top line in H1 2023. Everything's gone down. So the growth has dropped out from the market, which we know anyway. But value is very good. A lot of green here. Price to sales, price to earnings 9, price to book 0.8, EBITDA 5.6. So it's all good here, apart from the free cash flow. Health of the company, there was a decrease in cash of 20 million here. So net cash of 13. So they are investing a lot. But it's a healthy company. Current ratio, their current assets carry their current liabilities comfortably. Efficiency, margins are a little bit questionable, but they are a house builder. They're not going to be huge margins here. But return on capital is very good. And the forecast, not that impressive over the next couple of years. But like I say, if they scale up and their margins improve, that could change a lot. But that's what we have. Now, it's worth looking at momentum, very important. Look at momentum on the chart. So let's look at that. So we can see they're above 20-day moving average, but below all these moving averages, and the moving averages are not really crossing over, or they may be here due to lag effect. Let's have a look at the chart. As you can see, let's zoom in a second. So we've rallied, come down here from, this is like almost a 2-year, from 2021 was the high at £9 a share. Okay, and they've spent literally 2 years coming down to the bottom here. So the market's way ahead of what we've seen happening here. Since July, it's been selling off. That was the top of the bull market, pretty much. From July 2021, it's been selling off, and now we're 2 years in to this, which is in an average or a bit longer than a bear market. But we've had a bounce off the bottom. So test the low there, test the low there. It's rallied above the 50-day moving average and above previous highs. In fact, let's zoom in, we see this. So a good way of moving this is it's never really got above that 200-day moving average since November 2021. Okay, it's dabbled with the 50. It's tried to make it above, but in the end, it's got lower highs, and it's gone all the way down here. Then we see a significant break of the 50-day moving average here, and it also beats previous highs, which is a good sign. And then it breaks up high again and breaks the 200-day moving average. Like I said, not done since November 2020. But, there was a time where we thought we'd seen the Bank of England raise rates as high as they're going to go, but inflation hasn't come down. And so now they're reiterating that interest rates are going to keep going up and stay up there for longer, which has spooked house building, and just rolled over again. And it's tried to bring them out. But as you can see here, we've got literally a lower high. Didn't quite make the previous high. And it starts selling up again, breaking the 200-day moving average, 51st, and we're almost testing previous lows of January, October. So these previous lows here, in fact, that low, not quite, higher lows. This is very telling now. Will we get to? It'd be nice to see if we can get above this, or if a breakdown below these lows is a bit of a worry technically. So momentum isn't on its side yet, and I would say it needs. If you can see here, some sort of almost bit of support and resistance here. So it'd be nice to get above that, which it didn't do on Friday. 390, £4 as a range to get above that. Then you can safely say maybe we've seen the lows here, but it didn't do it. So there's still some price weakness going on. Let's have a look at some broker targets. Okay, so they've got an average of 40% for next year upside. It's not a bad average for next year. The maximum is 58%. As far as my sort of targets concerned, these are based on brokers, margins and top line, but this is the returns I'm saying. So for 2023, 20% upside, 461. 2024, that's 31% upside, and 2025, 54% upside. This could go a lot higher, of course, if they start successfully executing on that plan of having bigger sites, more units, bigger margins. But remember, of course, you are getting a dividend of close to 5% on top of this. So all in all, not bad. But as far as momentum is concerned, and this is the key thing, it's a little bit scary right now because the momentum could go further lower. The share price could go further lower because there's no momentum in the chart at all. So I would wait to see a break above that £4. Otherwise, there's a lot of bearishness out there. It could go a lot lower. Hope that makes sense. Please do your own research.